Hello and welcome to another episode of the Swing Trader Status Update. It's Justin Nielsen here, your host, and we've got a lot to talk about. It is February 25th, 2025, and we just suffered a pretty dramatic change in fortune in the markets. So we'll talk a little bit about that, but to help me do it is Mike Webster, our senior market strategist. How you doing, Mike?
Good. Can you hear me?
I can hear you.
Okay, good. Right. Perfect. I had muted it before because I'm having some construction in the house, so didn't want that to bleed over. So hopefully you can hear me during the entire show and I don't go crazy by all the industrial standing that's going on right outside my office.
Yeah, exactly. And of course, you know, you're not helping things as you're a little under the weather, so you've been pushing through. We appreciate that. So let's get right into it. We'll start with kind of the NASDAQ and just take a look at that. And what's so interesting about this market was that we were seeing kind of this this ugliness start, and it was really not showing up in a lot of the indexes at first. So the NASDAQ composite, until Friday, this break below the 21-day moving average line and the 50-day moving average line, it was really holding up well. But some of the first kind of cracks in the ointment, I guess. Axon, this huge day that started down and just got worse throughout the day, down 16.5% almost. You had Bros come down pretty sharply on Friday, but it was holding up there, for the most part. What was another big one that was down along with Axon? I'm trying to remember.
Oh my God, there were so many of them, and I've purged it from memory.
Palantir maybe.
Palantir
was down. I owned both of them, so it was like a double whammy hit there. But yeah, this was getting hit, 10% to the tune of 10% on Wednesday. But again, the interesting thing was that the NASDAQ was holding up still, pretty well on Wednesday. Thursday, it, was closing in the upper part of the range, still just right around 20,000. It really wasn't until Friday that things started looking bad. And the S&P 500, that was, again, no problem there on Thursday. I'm just going to go back in time because just to show how unconcerned the indexes looked. You wouldn't have thought that Axon and all of these things were coming in so hard.
Not at all. Let's look at that with that same change date. Let's look at the FFTY, which is the IBD 50.
Oh, there's some action.
So that was one of the reasons why we were getting, backing off of how deep in, because, earlier in the week we were like close to 120% in, and then we started reducing because of the damage that was going on, not on an index level, but on our space. And this isn't a perfect way to look at our space, but it's a good way of looking at these 50 stocks. And let's go out to today on here, because this is what it looked like on the 20th. Mm-hmm. Now, when you look at all the damage since, that is just really bad. So there's been so much destruction in really the kind of the hot names. And I would say the IBD 50 or, the hot growth names, a lot of them are, really high ATRs or on the higher side of, than your average stock in the S&P, as well as they're high valuations. And so when the market starts going after high value stocks, man, they deflate that balloon really quickly. And that's why we backed away really quickly, because you didn't know how much worse it was going to get. Look how bad FFTY was. Now let's go over to SPY, which I do have a position in. With SPY, it's like, not that bad, frankly, mm-hmm. on a relative basis. And if you look at that today, we undercut that last marked low, which many times can be, just the shakeout that you need, and what was our closing range by the end of the day? Last I looked, it was like 56, but yeah, 56.
It was 56. Mm-hmm.
So, anything 40 or higher would have been okay. and the higher the better. Obviously 85 would have been better than 55, and so on, but a little bit more than mid-range, which is a subtle sign of support. And how much were we down yesterday?
Yesterday it was down 0.46.
Okay, and then the day before?
The day before, that was a hard hit on Friday, 1.71.
Okay. So one of the other ways that we like to look at things, and this is something that we both learned from Bill, was when you're coming down, if you start coming down at a smaller pace. Now, it's not ideal that today's decline was basically the same as yesterday's. You would have wanted it to be smaller than yesterday's, but still, at least it was some supporting action. Now,
where it closed is a very different look, right?
Yeah, exactly. And then so we've got, the elephant in the room is tomorrow after the close, we've got NVIDIA's earnings. And that is going to really move the AI space, or it has the potential to move the AI space up a lot or down a lot, depending on what they say and how they say it and what they're not so much what their hard numbers are, their previous numbers, this most recent quarter, but what they say about the future, what they say about what's going on in China. They might just completely, just not say much there, and just do a pass on that. We don't know. And so it's going to be, it is a big risk event, not so much tomorrow during the day, but tomorrow after the close and going into Thursday. And then Friday, we've got PCE, which is just another thing to overhang. I'm not as concerned about PCE as I am about NVIDIA, but I am concerned about PCE because inflation is back as a topic, a real topic with the numbers we've been getting out of University of Michigan, as far as the inflation expectations are not
the
good.
Kind of sentiment, right?
Yeah. And, we're the market is clearly looking at, kind of thinking worst case scenario, or starting to price that in on some stocks of, inflation being sticky and growth slowing. And if that happens, that's not a good recipe. You want strong growth and low inflation and solid, employment. And, we don't know that that's going to play out that way. And so it is going to be tricky. And that's what we've seen over the last week. But I think we, frankly, we don't always navigate everything exactly the way we'd want. But you and I were talking with Dominic, our, the three of us are the SwingTrader crew. And, I think that over this last week, we've handled it right. We maybe you can walk through our exposure levels and how we did that.
Yeah, just 1 second. I was just checking something that Dominic sent. Speaking of, so you wanted to cover some of the exposure levels. So let's go. I'm gonna stop sharing here and share our slides. So here, again, just to remind folks, what we're doing is a 50-day rolling period. Look, this is swing trading. It's short term, so it's actually a little bit more important for us to look at this 50-day rolling period of our performance versus the S&P 500. And I also want to just point out two moving average lines that we introduced last week. The yellow is our 10-day moving average line, and the blue is our 21-day moving average line. Now, keep in mind that these lines are only off of the purple line, which is our swing trader performance, not off the black line, which is our S&P 500 performance. So you can see that we were getting some nice outperformance versus the S&P 500 throughout a lot of February. We had some really good gains in here. And then we were coming in to highs while we were starting to come in. And then that really accelerated. We got below that 10-day moving average line on our equity curve. And that's a big sign for, okay, hey, we might need to scale things back. At the bottom here, this shows what our percentage invested on a closing basis has been looking like. And you can see that coming into this, we were pushing it. We were kind of coming in heavy and on margin. This is the 100% level. So anything above that is on margin. And we quickly backed away, from being 118% invested down to 92%, down to 60%, right here. And then at Friday, we went into the weekend saying, okay, 0% is where we're comfortable, just all cash. And look, we can ramp that back up pretty quickly if things turn around. And, we were talking about some green shoots, some potential upside reversals, but it's just not quite strong enough to stick our neck out in a big way. So we've got, roughly 40% invested right now with the positions that we put on at the end of the day.
Yeah, that was, like you said, it was very late in the day. We wanted to make sure that because what happened yesterday is, didn't look that bad. And then what happens is you get late day sell-offs and make the charts look poor. So we wanted to wait as long as possible throughout today, sitting in cash. Like you said, on Friday, we went to cash. Yesterday, we went to cash. We stayed in cash, didn't do any trades, this morning. And then because of SPY it was really a lot about SPY undercutting that low, and then coming back up, which I was really expecting a lot more of a sell-off. And we might still get that. That's why we're only 40% in, and we've gone with things that are relatively low ATR, so low volatility with pretty tight stops. So if we get a really bad open tomorrow, we'll be, pretty much back to cash in a blink of an eye.
Yeah.
But we didn't want to be completely flat-footed going into Thursday, really, because, again, like we were talking about tomorrow, after the close is NVIDIA, that'll have a big reaction. So we wanted to kind of get some tests out there today, see how they work tomorrow. And again, we might ramp things up a bit, depending on if we get traction. We just listen to the feedback of the market. If the market is telling us our stuff is working, we'll increase exposure. If not, we'll back away. And I think the most important thing that you talked about was the 10-day moving average of our equity curve, that purple line with the yellow line. And that's what I think a lot of people, if you're swing trading at home, you should do with your equity curve. Put moving averages on there and use that as your feedback. When you're above them, that's when you got to push it. Like swing trading is a lot like poker. There are times where you need to be aggressive, and there's times where you need to be very conservative. And you can use what the market's doing as a guide, but also, and more importantly, your equity curve. And if you're above it, and we were staying above it, so we were pushing it. But then as soon as we came in, man, we just went to cash really quickly from 120% in to zero in a really short period of time, as fast as we could with an outside product. Obviously, if this was our own money, just running it as a hedge fund or something like that, we could operate quicker. But we also know that people are following alerts, and we try to be fast, but not too fast that we can't be followed, because this is a product, it is a service, and we're trying to help people actually be able to do. So we flatlined for a couple of days because we were in cash. So
I did see someone say that they thought that it was broken.
No,
there was nothing happening. No, and this is where, look, sometimes reading that market action on SwingTrader will kind of, again, between these events, I do update that, and I haven't updated it yet today, but I will get to that as soon as we're done here. That's going to let you know, hey, yeah, it was 0%. We're still 0%, and here's kind of why, so you know that it's not broken. We are going to eventually revamp the product so that instead of kind of giving those error messages, it's going to say, hey, we're in cash on purpose.
Yeah. So the other thing, as far as how deep in the market, what I would suggest people to do, it's very easy. If it's a full position, it's roughly 10%. If it's a half position, it's 5%. A quarter is a 2.5, and so on. That because sometimes, you and Dominic will get busy because all three of us are doing 15 million things a day, and we can't do all 15 million things. So if the thing doesn't get updated right away, you can just do the math on your own. Like if you see 0 stocks, you're 0% invested. If you got 4 stocks like we have now with 10% each, even if it doesn't say it, it's 40%. So, because wish we could do everything, but we just simply can't. But I think this is something that everyone should do at home and plot out to how deep in the market you are, because that's what this service is about, is making sure that, people have a style to follow. You don't have to follow it trade by trade, but just see, like, okay, what do the guys do? Okay, when they're doing well, they increase exposure. When they're doing poorly, they decrease exposure. Markets doing well, they increase exposure, and so on.
And sometimes being at 0%, some folks would at times be like, oh, hey, we're not paying you to sit on your hands and do nothing. But sometimes the decision to do nothing is a hard one for a lot of people, and it's something that you can get a lot of outperformance versus the S&P 500 by having that discipline to be in cash when it's necessary. So that is actually, it's a feature, not a bug, right?
Oh, it's probably the most important thing. The percentage. I would look at this product not as the picks, not as the entries or the exits. I would look at it as the market exposure. If I were to say someone wants to take SwingTrader, and only look at how deep in the market we are as their guide, as a market exposure for their own trading, that's how I would look at it. I would start there and then go into, all of the other aspects of it. So if we go to cash, we're making a statement, and it's an important one, and it's not by accident, And so that was a clear statement, and I think collectively we would do the same thing again. And I was talking to you earlier today about it. This was kind of a rule that I took back out of the toolbox that I used to use in the 90s before I was trading for Bill. That if I had I had like circuit breakers for my own account, and I was primarily swing trading back then, my own account. And if I got hit hard in a certain way, I would go to cash, regardless of what day it was. I would go to cash until the following Tuesday, 35 minutes into the open. And that's something that I learned really over a long period of time of testing out different types of circuit breakers. And what it did is, let's say it was Monday of the week and I got hit really hard and I went to cash on Tuesday or late on Monday. I would wait all the way until the following Tuesday, 35 minutes into the open. I would suggest people try something like this. And what it does is it forces you to stay engaged in the market. And wasn't like I would go on vacation. I would create a watch list every day, like watch stocks, see if the stocks that I was looking at were working out or fading, make sure I had a feel, do the same work all over the weekend, and then sit on my hands all day Monday. And it's probably the best thing that I've done over the years is when I take that back out of the toolbox, because it forces you to kind of stay on your game. And it might sound silly, but if you really put thought into it, I could probably talk about this for 2 hours and I won't, so I'll stop now. But really think about implementing a circuit breaker rule for your own trading.
Absolutely. So, you know what? Just one of the questions that I'm seeing, I'm looking at the YouTube comments here, and again, we really appreciate you folks joining us live. I also want to just give a shout out to Hugh that I met in Las Vegas at the Money Show. He was easy to spot out. Every day, crazy shirt, and it was like, oh, yep, there's Hugh. So good to see you, man. But let's talk. A few people are asking about, okay, so we went to cash, seemed like the right plan. A lot of folks are saying, yeah, nothing happening is all right by me. But so why add today? And we can just look at the pie chart real quick. As you mentioned, we added 4 positions. We're pretty spread out: leisure, internet, financial, and then a broad ETF with SPY, a leveraged version being SSO. So still a lot of cash, 60%. But why? What was it that you were seeing that said, okay,
good question.
These are good enough to try? And was there anything about some of the ones you passed on, why you passed on?
Yeah, absolutely. So let's go back to the S&P, because that'll pretty much tell us.
Tell the story.
Tell the story. Well, actually, we could start off with NASDAQ, and this will be the reason why we didn't go with the Qs, because the NASDAQ is still weak.
Here it comes.
Right.
Okay,
there we go. So with NASDAQ, it's still in this weak position, even though, we came off of our lows. But when we broke through that, the last marked low, and the marked highs and lows are very important part of what Justin and I do, and what Bill did, that when you undercut that, you should shake out and come back, and you want to go back above that level, and you didn't get there because it's still, on the weak side. Now let's go over to SPY and see that positive divergence. You shook out below that marked low and closed back above it, and just underneath your 50-day, and just underneath that, important psychological level of 600. So the fact that this was holding up so much better than what Nasdaq was doing, and then also let's look at the FFTY, that even though that one, has been getting hit so hard, like this felt like almost like a capitulation ish type of around its 200-day, like it was, the selling that was going to happen. I don't want to say capitulation. I shouldn't use that word, because capitulation normally implies a much bigger bar, and then closing back up. But it felt like the selling had kind of dried up there. This chart is broken and looks terrible,
Well, and certainly, here again, it's a little bit different when you're dealing with, indexes as opposed to stocks. But you undercut that 27.98, this low right here, which was a support level right there, and then closed above it.
Yep. Yeah. So let's go to a team. This is one of the ones that we were looking at and didn't put on the list. I did buy a small position in my own account, but we didn't buy it because it wasn't strong enough to put on SwingTrader today. And the reason being is it's still a semi-broken chart in that it broke 4 days ago. Like the day that it broke through 300 and also broke through the 21-day is really where the chart broke. Like that first day that you marked to, that selling, you should have had the shakeout that we had at the 21 and then moved back above that low if it was healthy, but it wasn't, and we had more selling there. And then you came into this base, which I'm not a fan of. I would have liked it to stop on top of that. But I do like this stock, and I like the action, and I like that we have a tight stop. And that's, to answer your original question, that was a lot of the reason why we went in with some stocks today, is because each one of them, we have a very tight stop on, so we're not risking much. Whereas if we would have bought a team 3-4 days ago around 300, that would have been fine there, because then our low would have been the low of that day, or our exit would have been the low of that day. We wouldn't have sat through, the mess the last couple of days. But, and that's why we weren't buying any of those things, because there was no logical exit. We didn't know how much lower it was going to go. So this is one that, like, again, I bought personally, but we passed on. But the one that we did put on was MasterCard, and I did end up buying a position in this after our 30-minute window. And this was very classic, a low ATR. It's formed this little shelf after it kind of, it ran up. It didn't really come out of a proper base or anything, but ran up above the 550, held in nicely after its earnings, had an outside day, upside reversal. Like, if you don't buy this today, where do you buy it? You buy it extended. And that's what we didn't want to do, is to buy it extended, because then we would be taking on more risk. So we were better off putting some things on today where, really our low from either today or at most that low that you have there around 550 would be the most that we would let this go against us. We might not even let it go against us that much. If we wake up tomorrow to a really weak tape, we might just back away or start reducing positions, out of the box. But these were the things that we were looking for, or kind of more cookie cutter setups, from a swing trading standpoint, with a really clear exit. And let's go to SPY, which again, I have a position in that I bought it. And I was short SPY coming into today since Friday. I was short Qs heavy, short SPY a little bit, and then, close those out earlier today. But with this, we have today's low is really our exit. So it's really not a whole lot of risk unless we deal with a major gap down. And there wasn't any news that's supposed to come out tomorrow morning that I saw. There was a risk event. It's really tomorrow after the close. So this was a tough one, and I don't know that we're going to be right about these trades. We'll just have to see how tomorrow is. And that's why we only went 40% in. And it's really not a true 40% because it's the S&P, even though it's a 2X, but it's 500 stocks plus some kind of slow stocks that we put on, like the MasterCard. So we're not taking on a massive amount of risk. If we were putting like a Palantir on, I don't think I bought that today, but let's pull a Palantir off the 50-day, which is something that someone could have traded. Like that's taking on a ton of risk. Even though this is where it should stop, right? You've had what, 1, 2, 3, 4, 5 days down, finding support at the 50-day. It's still on a weekly. It still is intact. It's not broken there. I mean, this is something that we could have taken a shot at, but if we woke up tomorrow to this being down 8%, would we be surprised?
Right. Yeah.
No, right? And so we didn't want to take on that type of risk, but it did feel like at least short term, the selling had, was starting to dry up. We're taking calculated risk here. And again, if we get a weak tape tomorrow, we'll just back away and go straight back to cash and wait for the NVIDIA numbers and to see that reaction.
Mm-hmm. One more stock to cover, Spotify. This was another one that was skipped. So it has a break below the 600 level, a break below the 21-day moving average line, but it seemed like it was, showing some supporting action right around the low of the gap up day. So again, maybe talk a little bit about why not on this one.
Well, and I did buy some in my own account when I decided that we weren't going to put it on SwingTrader, because one, it was still underneath the 21-day in kind of a no man's land type of position where it could still come into the 50-day and be normal and natural. Like you're always asking yourself, what's normal and natural? What breaks the stock? What doesn't? And this thing could come all the way into the 50-day and still be normal and natural. And that's why we didn't take that chance today. Now, if tomorrow it takes out today's high and it moves back above 600, we might give it a shot, and then I'll just have to sell what I bought today. That's fine. I'll sell it before we put it on, obviously. But we wanted a little bit more strength. So each time we put something on, we're really being careful about it and really thinking through. It doesn't mean we're going to be right, but there's a lot of thought that goes into it. It's like, this wasn't perfect, but what was good about it is, it's something that we can understand. It's a product that we all use, in that it's a quality product. Earnings are behind you. It's been a leader. It's got a strong RS, and it's held up a lot better than so many other names. And of course, we've got that power from Pivot on there, the 25% flag that you see there on the weekly, or 27 on the daily, showing that it had that power out of its base, which is something that, of course, we all like.
Yeah. So yeah, definitely one of the things that is worth mentioning, that because someone asked, are you guys buying these stocks in your personal accounts? A lot of times we do like to eat our own cooking. So our rules are that we have to give you guys first shot at it. So we have to wait half an hour, 30 minutes before we can buy them. And you probably do a lot more buying because you do the shotgun approach a lot of times. You're going to have small positions, and a lot of them. I personally, I can't do that type of style myself. I get too busy with things and I can't keep track of things. It's too much for me. So I tend to be a little bit more like what we're doing on SwingTrader right now, where I'll go a little bit larger, and then if it doesn't work, I'm cutting it or trimming. And then if it does work, sometimes I'll even add to it. But not completely following along, because sometimes by the time that 30 minutes elapses, sometimes it's up and out of there, and it's like, okay, now this doesn't even make sense anymore. It's too far extended. Or sometimes things will go on at the end of the day, and I don't have a chance to buy it. So or sometimes I'm full with other things in my portfolio because I do a combination of some position trades and swing trades. So again, the whole idea behind the product is you're kind of making it your own, and that's certainly, I think, what we're doing as well. One other question.
Yeah,
from
just to answer from my point of view for that, I did buy all 4 of these after our window. And just to be clear, I know we say it all the time, but we might have some new viewers. We can't buy it. If I own Spotify, I can't put Spotify on. I have to sell it first, and I do that all day long. I put SwingTrader above my own trading. 100% of the time, not 99% of the time. And then so I wait the 30 minutes, and even I think the last one we put on was SSO, and that was I had to buy it in after hours to get the position because
3 minutes after
like
the
3 minutes.
Yeah.
So I put something on and I say, "Hey Siri," and then I say, set a timer for 30 minutes, and then that 30 minutes is up, and I go start buying it. That's just kind of how I operate. But I'll own a lot more things than we put on SwingTrader. And that's what we were trying to do last year. And it just didn't work out because I buy a lot more stocks than most people are comfortable with. And I think it was just too much for people to follow.
One other thing someone was asking, because I referred to the market action, someone was asking where that is. For those of you that are subscribers to SwingTrader, you're going to see that right in the top right-hand corner of both the current trades and the past trades. So you can look on either one of those. In fact, you know what? Let me see if I can do a quick share on our past trades and kind of show what it looks like. So you can see that, right? Yeah. So right up here, it's going to show what the indexes are doing after hours under this market action. And if you click here on the more, you'll see again. This was as of yesterday's close. I'll update that in just a little bit. But look, early morning strength faded to more losses by the close, and we continue to avoid positions for now. So that's going to kind of explain why that 0% right there. So hope that helps. And I think that's all we got for today. Any last thoughts, Mike?
No, just stay careful and stay nimble out there. Just another reason why we didn't stay in cash is we want this product to be something that's helpful to people. And one of the dangers is over trading, but also freezing up and not trading when you should. And if there's opportunities there, you want to take it, but as long as it's a calculated risk. So we'll see how the next couple of days play out, and we might be back in cash. We might be 100% invested by Friday. Who knows? We'll see.
Well, and that's also just as a very strong reminder, something that you and I both learned from Bill O'Neill, the founder of Investors Business Daily, is that flexibility to not go with planting your flag in the sand and saying, okay, this is what I believe should happen, famous last words, and then new evidence comes in and you just ignore it. I was actually having a very strong conversation with my son yesterday. There was something where it was, he changed his mind and he felt bad about it. I'm like, no, you used new evidence, and you changed your mind for a good reason. You had very solid reasoning behind that. So I was trying to encourage him that changing your mind is okay, even if it's something that you were very passionate about, just a week ago. And again, this is something that Mike and I both witnessed firsthand.
And I'll say, like, it's the same thing back in like 1986 or so when 5150 came out. Like, I used to think David Lee Roth was going to be the best singer of Van Halen ever, and then I found out it was really Sammy. Sorry, I had to. I couldn't help it. But
yeah, see, you changed your mind. Evidence came out.
I'm so proud of Nicholas. That is what a great kid. And yeah, that was the number one thing we learned from Bill. And you and I both have so many stories about seeing him. I mean, that guy was not neutral. He was either bearish or bullish, and that he would change on a dime, and it wouldn't matter. He would call me up midday on bad days, like what we had over the last couple of days, almost to talk himself through the anxiety that he would have in the market too. And then by the time the call was over, it was typically he would call either myself or Charles, when things were really bad. And then by the time the conversation was over, we would have come up and it was funny. It was like all the time, and he laughed about it because he'd say, "Okay, well, I guess the market's rallied. We can get off the phone now." So, it was very cute, and you could almost see, like, once we would start accelerating on the downside, that phone would be ringing, and then we would be going through stocks and everything like that and getting a sense of things. But it was really like, you always want to live in that moment of, you want to have fear in the market, because the market is just like the ocean. You can have a lot of fun on the ocean, but it can kill you as well. And so the market can do the same, and you need to be just really be able to react accordingly. And that's about it. I know I've babbled on too much, so we'll call it.
Okay, and for my final thoughts, one thing I want to address that someone was putting in the Q&A for YouTube, and this is something that we're gonna work on. We actually were talking about it earlier today. The half positions, so that was something that we did, just a few weeks ago when we were in kind of a tricky market. We started with half positions with the intention of either adding to them or but it does get a little bit tricky. So what we want to do is we want to, again, have something that's easy for folks to follow. So we have to think through some of our rules on that. I kind of like what we did last time. This time we're, again, staying small with some of these, staying small instead of how much invested we are. But another way to do it is with half positions. And that's a completely legitimate thing for you to do in your own portfolio. Nothing says you have to do full positions of 10% right now. You could do half positions, but it does get a little bit trickier when, for our product, because then if we have a bunch of half positions, then we start getting a lot of stocks on, and that can be a little bit tougher for people. So we're trying to find that happy medium of what most people can follow. We can't, of course, personalize this to any one person. This is a general thing. So that's kind of the answer to that, and we're working on what that happy medium is. So thanks for that question, a great one. And Mike, I think that's going to wrap it up for us this week. And thank you so much. I think a lot of people are very appreciative of, again, being in cash when we were. So I think there's some gratitude there. So we appreciate that, folks. Okay, that's going to wrap it up for us this week. Thank you so much for watching, and we will see you all next week. And also, if you want to get a little bit more of Mike Webster, he and I are going to be on the Stock Market Today video on Friday, so you can catch him there on YouTube, and also live on YouTube. We go live right after the market close, so catch us there, and we will see you next time. Take care.